Another Goldilocks non-farm payrolls print on Friday again pointed to a soft landing for the US economy, and the market reaction was pretty textbook, though it must be said. The full effects of that has yet to be seen due to the various Easter holidays taking place around the world. In Europe, at least, it's another holiday-shortened week this week, but it's going to be another busy one for sure. Plenty of data and speakers on the docket, with the US inflation number the main focus as markets continue to price in around 75 basis points worth of cuts from the Fed by year end. And of course, earnings season kicks off as well towards the tail end of this week with some of the major Wall Street banks reporting. Plenty, as always, for Ryan Littlestone and I to discuss in the trade-off this week. So without further ado, let's get into the show. Well, as I said, another busy show lies ahead. Plenty for us to discuss. So without further ado, Ryan from Forex Flow Live on Forex Analytics. Good morning from a very rainy, wet and miserable London on this bank holiday Monday. I'm assuming it's not quite as rainy and miserable where you are in southern Spain.
No, my heart bleeds for you, Michael. I did see a cloud the other day, just floated past the window, and haven't seen one since. So, yeah, I'm back to reality over the next few days. So I'm enjoying it while it lasts.
I'm sure you are, and the great British weather has come out in force for you to welcome you home. And of course, you'll be back in London in time for that CPI number on Wednesday, which I'm sure you're excited about to bring your holiday to a close with that. But anyway, we've got plenty to discuss before we get into that. So let's roll into Topical Thunder. So I want to start with the US labour market report that we had out on Friday. Another, what I would call a Goldilocks report out of the States. Headline non-farm payrolls rising by 236,000 in March. That is just above the consensus of 230,000, which makes it the 12th upside surprise compared to the expectations in a row, which extends a record run going all the way back to around 1996. The other areas of the report, easy for me to say, were pretty solid as well. Unemployment down to 3.5%, despite participation rising to a cycle high 62.6%. So although more people coming into the labour force, more people looking for jobs, unemployment going down, that's a very, very positive sign indeed. And earnings increasing at a healthy clip, but not an inflationary clip of about 1/3 on a monthly basis, and the year-on-year pace cooled to around 4.2%. So again, a Goldilocks report, not too hot, not too cold, just about right when it comes to the US labour market. And again, pointing towards what we would call a soft landing for the US economy. I think for me, Ryan, what's remarkable is the resilience of the labour market. Of course, we know the jobs market is typically the last sort of domino to fall when it comes to going into a recession. But there's really nothing in that labour market report from where I'm sitting that screams slowdown, that screams recession. And I think that all the time we're getting prints like this, it supports the Fed's hawkish stance. It supports this idea of higher for longer. But the market is just refusing to play ball with that. We've still got 75 basis points worth of cuts in the curve for the remainder of this year. The 2-year is stuck resolutely below 4%. And I just wonder how this kind of battle between who is right, whether it's the Fed and whether it's the market, how that's going to end up resolving itself.
Well, if the market keeps pushing long enough, it's going to be right eventually. But like you say, the jobs market is very, very solid. And, you know, everyone's been waiting for this to roll over, you know, me since the beginning of the year. And the fact it keeps trucking along, it keeps showing solid job gains, is quite remarkable, because there's not even been any wobbles. You know, we expected maybe some wobbles over the new year. You know, you get that holiday hiring coming out of the market. Nothing. It's been solid, like you say, and it is very surprising for us. And trying to trade it, it's just a case of, you know, waiting to see when it rolls over, if it rolls over at all. But like you say, it's going to keep the Fed underpinned. Wages, you know, they're still looking pretty good. And as inflation comes down, then that gap between real wages and inflation sort of closes a bit more, makes it a bit better for the economy. And like you say, it keeps the Fed on track, most definitely.
Yeah, absolutely. And in many ways, the beat on the jobs number was quite surprising, especially considering that initial jobless claims have started to tick higher. Some of the PMIs that we got last week weren't particularly pretty, particularly when you dig into some of the detail and the employment indices in the ISM prints that we got last week. And of course, the JOLTS number, the job openings figure, below 10 million for the first time since May of last year. So there are a few warning signs out there, and perhaps you would say that this is a question of when rather than if things start to roll over. But then again, we've been saying that for the last 6 months or so. And I think, as I said, a report like that really does cement the case for another 25 basis point hike from the Fed in May, and probably that not being the last one either.
No, I quite agree. You know, they've on their path. They have got this, I wouldn't call it a pivot, but, you know, they've definitely eased off the gas in terms of the rhetoric since the last FOMC and what's happened with the banking stuff that's gone on. But while the data still conforms to their line of thinking, they're going to keep hiking.
Absolutely. It's a data-dependent central bank. And like you say, the data says hike, they're probably going to do it. But I don't want to get into policy rates too much because I'm stealing your thunder, quite literally, pun intended, from a little bit later on. So let's get on to China, because that's an interesting one bubbling away, isn't it?
Yeah, definitely. And, you know, even just coming over the weekend, there's been further headlines in this China-Taiwan situation going on. You know, there's been drills where China's, you know, practiced encircling Taiwan, simulating strikes on Taiwanese targets. And it's just a further stepping up of this rhetoric that we're seeing. And it's to me, it's no coincidence that this is happening straight after Xi's met Putin, and, you know, they've reaffirmed ties with Russia. And it's creating further tensions also between the US and China. You know, we still sort of daily have this tit for tat headlines going through about, you know, US putting, you know, further sanctions on Chinese companies, what's going on with TikTok. It all seems small stuff underneath the surface, but, you know, these bricks are piling up. And when we turn to military action, you know, China pushing the boundaries of their claim to Taiwan, I don't think the market is really getting into it at the moment, but I think it's becoming a bigger and bigger, you know, devil on the shoulder, if you like, a bit of a conscience play that this rhetoric is stepping up, and we're hearing more and more of these headlines, and they're growing and growing and growing. You know, but then you've got France's Macron also coming out after his visit to China saying, you know, if the US and China do get into a bit of a spat, it's not for Europe to follow in the footsteps and
well, they'll just wave a white flag
in this thing. So, you know, there's going to be some dividing lines there, and the market perhaps is going to start to become a bit more susceptible to the headlines coming out of that, and we've got to see what that does for prices and risk.
Yeah, I think you're absolutely right. I think more broadly, geopolitics is starting to come onto the radar a lot more, not just in terms of what's going on with China and Taiwan, but of course, Russia, Ukraine, that's still not solved. In fact, that's very, very far from being solved, sadly. And of course, you're starting to see tensions rise again in the Middle East as well. It's you know, Iran and Israel seem to be, well, the war of words there is certainly heating up, to say the least. And I think this is a classic case where it can be quite difficult for traders of all levels to sort of participate and get involved with this sort of thing, because it's not really a theme that you can position for now. If you were, you know, short equities right now at the cash open when we open this week on the basis of geopolitical risks heating up, you're probably going to get stopped out before any risks actually come to fruition and anything kicks off. I think instead it's just another example and another bit of evidence as to why people need to be nimble and why people need to be agile in terms of what's going on, be on top of the news, know the market you're trading, and almost have a plan which says, if we do see something kick off in the Middle East, this is what I'm going to do. I'm going to buy it again. I'm going to buy gold. I'm going to buy oil. I'm going to sell equities. Whatever it may be, have those playbooks in place such that even when these risks really kick off, then you know what to do. You're pressing one button and you're positioned for whatever risk you think is going to happen. But I totally agree with you. I think this is certainly something that traders need to have on the radar, because as far as it seems, the rhetoric is only going one way, and that's to heat up.
Yeah, definitely. And you're quite right. You've got to look at the right assets for the right situation. You know, in terms of China and the US, you're obviously looking at the dollar, you're looking at the Chinese yuan. then perhaps you're looking at Japanese yen as well. But like you say, something like this is going to be big for commodities, particularly something like gold. You know, if you get two of the biggest superpowers on the planet going head to head, you know, assets like gold are the ones that are going to shine. Pardon the pun, as you would say.
Yeah, I was going to say we've got quite a lot of puns in the show today, haven't we? Well, gold is quite a good inflation hedge, so let's get on to talking about that. We've obviously got the US CPI numbers out later on this week, Wednesday afternoon. We've got the inflation print out. As I said, that solid payrolls print that we got on Friday really does support the higher for longer case. I think it's going to embolden the hawks on the FOMC and certainly makes a 25 basis point hike in May my base case and also the market's base case. When I checked the Fed Fund futures pricing after the payrolls print on Friday, I think they were pricing about a 70% chance of a 25 basis point hike. Obviously, if we get a hotter than expected inflation number, then you would expect that probability to rise even further. I think it's going to be interesting because obviously the CPI number is really the last major data point that we get before the next FOMC. The Fed meet on the 2nd of May, so it's early in the month, but we're not going to have another jobs number. We're not going to have another inflation number before then. So it takes on extra importance as a result of that. It's also likely to be quite interesting because if you look at the forecasts for the report, headline inflation, as we discussed, I think not last week, the week prior, is expected to continue coming lower. 5.1% is the expectation compared to a 6% yearly print prior. Again, energy prices, food prices coming lower, really helping that headline print to decline. But where the problem comes in is that core inflation is not only expected to stay elevated, but it's expected to re-accelerate up to 5.6% year on year from a 5.5% prior. And I think this is where the real concern is for policymakers at the very least, is that although you're seeing headline prices fall or headline inflation fall, but obviously prices are still accelerating, albeit at a slower rate. When you strip out energy, when you strip out food, core inflation is still rising at one hell of a clip, almost 3 times the Fed's target. And really, there's nothing there that shows that falling anytime soon. And I think the other thing that you've got to remember from a psychological point of view is that policymakers let the inflationary genie out of the bottle once back in 2021, 2022, when we had the whole transitory shenanigans, all that jazz. They're not going to want to do that once again. And I think we're likely, therefore, to see, perhaps some would argue, a hawkish overreaction and perhaps an over-tightening rather than them taking their foot off the brake pedal anytime soon. The last thing I would say just on inflation and central banks more broadly is looking at the diary. Jay Powell isn't scheduled to speak between now and the next Fed meeting. I think it may just be worth keeping an eye on whether some remarks are slotted into the diary at some point soon, just to guide the market one way or another, particularly, I think, if we see that pricing of cuts before the end of the year really start to ramp up. Then I wouldn't be surprised if we heard the Fed chair come out on the wires and put a bit of an end to that. What are your thoughts on the inflation number this week, Ryan?
Yeah, I think you're right. You know, we've got our old mate, Timmy Leaks, Nick Timiraos at the Wall Street Journal, who likes to drop, notes from someone at the Fed when it's appropriate. So that's the sort of thing we've got to be looking out for, as you say, regarding Powell, and maybe dropping some lines in before the next FOMC. There's obviously plenty of other data. We have got retail sales this week as well, which is going to be good to see what's happening on the consumer side. But in inflation, trading wise, we've switched now. It's now the shock is going to be if inflation jumps. You know, particularly in the US, it's been coming down, almost 9 months now. Headline, that is. The core is very sticky behind, and we're seeing that in other countries as well. The ECB, Europe, also having a problem with the core inflation. So it is very important. The market has seen inflation coming down, as I say, but there's a big surprise if it starts moving up again. The core, it's a difficult one with the core because it lags the headline number. So if the headline keeps coming down, the core should follow eventually. How long that takes is another question. But if we see a jump in headline inflation, and like you say, with that jump in core inflation, it's going to be very rough for the market and the Fed, and especially those in the market, as you say, are pricing cuts again, because the Fed are going to say the job's not done yet and we're going to need to keep hiking, and then the market's going to have to rethink its rhetoric around cuts and stuff.
Yeah, absolutely. And of course, the dollar has really not found much love at all over the last couple of weeks, or even last month or so. I think we've now had 4 or even 5 weekly declines in the dollar index in a row. Obviously, that's heavily weighted towards the euro. So caveats apply there. But, you know, if we do start to see the market price out some of those cuts, if we do start to see treasuries sell off and yields rise, then maybe that will allow the dollar bulls to come back into the market just a little bit. But I know you want to get into the subject of cuts in a little bit more detail.
Yeah, definitely. And, you know, we have switched, you know, the last year or so we've spent trading the Fed and all central banks hiking. There's still some surprises out there. We've still got, you know, the AUDNZD going for a surprise bigger hike than expected. But the market, and talking mainly about the Fed, is still playing this pivot trade. You know, when a cut's going to come. It's been quick to jump on that again. As you say, yields have been hitting, you know, recent lows. The dollar's on the back foot. And, you know, the Fed is going to be the A game, but there's also that divergence between different countries. You know, Aussie and Kiwi, 2 of them, case in point. And, you know, the dollar went a long way on the upside, and it's given a good chunk of that back. You know, if you look at something like dollar yen, you know, it's given pretty much half of the gains we saw back again. That doesn't mean that if we start getting into cuts, you know, the dollar's going to collapse or anything like that, you know, unless there's some other big risk headlines going on. But while the data sort of meanders around, like you said, with the PMIs, you know, the services, the ISMs, you know, in the main pretty good, but some wobbles in manufacturing, this divergence between services and manufacturing, and the numbers looking a bit edgier again. I think you're going to see the dollar get hit. You're going to see yields, anytime the yields rally, they're going to get hit as well. I think the market is set up that it's not going to let go of this bone of when the Fed and other central banks start cutting rates. And that's what we're going to be trading probably over the next few months ahead. So even if the Fed turn around and say they get a strong inflation number this week, yeah, hikes are still going to go. We're still going to take them higher. The market isn't going to get that hawkish about it again. You may see the dollar rally, yields rally, but I don't think those rallies last long. And so if we know that bias, we know which way is the path of least resistance. And, you know, rally selling the dollar would be the way to go forward.
Yeah, I absolutely agree with that. I mean, I think we've spent a long time trading the dollar from the long side. And obviously, there's been numerous reasons for that. And if you just take it back to what we would call the dollar smile, where, you know, really traditionally in the textbooks, at least, there are 2 reasons for the dollar to appreciate. On one side, you've got global risk aversion, big risk off, equities coming lower, haven demand. And on the other hand, you've got US economic outperformance, you know, stronger growth, higher rates, all the rest of it compared to its G10 peers. At the minute, the US doesn't really have either of those going for it. We're not in a period of massive risk off. And even when all the banks were going to the wall, we didn't have huge risk aversion coming into the market. Yes, equities came a little bit lower, but there wasn't really that much haven demand, particularly for the dollar. And then on the macro side, if you look at where the Fed funds rate is, it's not particularly much higher than its global peers. And of course, the Fed are starting to turn a little less hawkish in terms of their rhetoric and also in terms of the statements that they're putting out. And of course, the market is also pricing in rate cuts. So we're sitting almost bang in the middle of this dollar smile at the moment, which means realistically, as you say, the path of least resistance for the greenback is lower because there is no convincing reason to be buying it at the moment. I think, you know, you do look, and there are perhaps some exceptions to that rule. I think sterling is one, which I'll get onto in a moment. But by and large, I think we are in a period where dollar bears are in control of the market. And unless we see a much more hawkish Fed or a big bout of risk aversion coming in, that's probably likely to remain the case for the foreseeable, I think.
Yeah, definitely. But you also got to look at the market. It likes to go too far on something. So, you know, we're pricing 75 pips worth of cuts by the end of the year. I think we're getting into the extreme other side of the boat. So, you know, that also becomes an opportunity. If the market pushes too far in one direction, that's when you think, well, look at the data. It's the Fed aren't going to start cutting, you know, 75 pips by the end of this year. So the market is wrong on that. Then you get a little bit of an adjustment when you get the data showing that they don't need to cut by as much. So there's plenty for both sides, but I think that the bigger trend is going to be the market moving towards cuts.
Yeah, I would agree. I do think, actually, and I might do a segment on this next week, so I'm not going to go into it in too much detail. No, me, I'll probably forget I've said that now. But I do think the 75 basis points worth of cuts, I think there's a debate to be had over, is that the market saying 75 is our base case? Or is that the market saying there is such a distribution of outcomes where by year end rates could be between 50 basis points higher and probably 250 basis points lower than where they are now? And this is just kind of the midpoint of that probability distribution. I'm not convinced that when you look at, WERP on Bloomberg or the Fed Watch on CME or whatever, I'm not convinced that everyone's saying, and I'm guilty of it, 75 bips of cuts is priced in. I'm not convinced if you did a bit of a straw poll of investors or on Twitter or wherever, you would get that as your median expectation. I think it's more of a probability distribution than anything else. But that's a topic for another day. We've spoken far too much about central banks, I think. Sorry?
I'll put it down for you.
Yeah. Yeah, I'm going to have to make a note as well. Got a whiteboard there. I'll scribble it on that. Let's move on to some charts. That's the setup is next. So I want to look at cable first of all. Three reasons I'm doing this. One, it's a nice looking chart. Two, the little bit of home bias coming in. And three, I thought I'd be nice and give Mr. Blake Morrow something to steal when he comes to do his version of the trade-off a little bit later on this week. We've come up to this huge 124.45, 124.50 level once again, and we actually made a closing break of it last week on Tuesday and Wednesday. And that was important because obviously we've tested this level twice since three times now, but twice since the tail end of last year. Twice it held. On the third time, we finally broke through it. But again, sellers came in relatively quickly around the 125 handle. And we're now back below in early trade this morning, although obviously the usual caveats around abysmal volumes and liquidity at this time of year apply. We are now back below what was resistance at 124.45. So very, very short-lived foray above that level for the quid. I do think personally that is important because it shows that the bullish momentum has stalled out relatively quickly from a technical point of view. And of course, we're now below this ascending trend line that's been running things since around the beginning of March. But then, of course, from a fundamental point of view, the pound still doesn't really have that much going for it. You've got to remember, inflation is considerably north of 10% here at a headline level and accelerating. Core inflation is accelerating as well. The PMIs last week were okay, but I wouldn't say they really knocked it out of the park. And of course, you've also got the issue with the Bank of England, where a couple of policymakers are openly calling for rate cuts. And I think the likelihood of the BOE having concluded their tightening cycle is pretty high at this point. So although we had that break last week, I don't think sterling has particularly much going for it. If we can get a closing break of that 125 handle, then obviously that would flip the bias into a long position. But I think for now, I would certainly, although more broadly I'm bearish on the dollar, I do think cable is perhaps likely to buck that trend just because the idiosyncratic factors affecting the pound. Sterling really does not have much going for it at this juncture. Ryan, what are your thoughts?
Yeah, I'm slightly different. The thing with the UK and particularly the pound, it always has a chance to do more. It's always doom and gloom here, coming into the end of the year, into the new year, recessions, how bad's it going to be? And the data, it's not been spectacular, but nowhere has it been spectacular, unless you look at somewhere like we saw in the PMI, Spain,
Yes.
big services number last week.
Yeah, how much beer have you been buying out there to prop that up?
I haven't finished yet. It's the wife who's been shopping. We tend to buck the trend. When everyone says, the UK is going to be on its knees going into a fiery abyss, that's when you see it bucking the trend and doing something that's not so bad. And the thing with the pound and particularly cable, it can go 500-600 pips and you think, right, well, that's enough. And then it goes another 500 pips. That's just the way it is. I think for cable, we've had this break. So perhaps it's cracked the egg up here. Even though we're back below We just need to see, is the level going to reassert itself, or is it going to become a bit wishy-washy and we get a move, a bit above, a bit below, and see if we're going to hold some new highs or create some new highs. But I think it's a bit two-way here. With the dollar side of the trade, the market, as we said, looking a bit more bearish, the dollar, if they're going to be bearish or dovish, the Fed. So that's going to give you the upside risk for the pound. But I mean, my thoughts of the Bank of England, and as you said, inflation is still 10%. How they can pause and not take rates higher in that situation, particularly if inflation doesn't come down, is beyond me. So I'm still expecting my 5%.
It's punchy. I saw a post on LinkedIn. We'll move on in just 1 second on my way in this morning. So I'm just going to steal the question to ask you. What do we see next on cable? 130 or 125? Oh, 120 or 130? What do we print next?
I say 130.
I'm going to take the other side of that. Let's see what happens. Dollar Chinese.
Yeah, that's one I'm going to be looking at now. And this is really coming from the risk play that I was talking about with the China tensions that have been developing further. And I think for this one, you want to be looking from the long side. If it does kick off in any which way, then I think the initial reaction is going to be the market investors getting out of China. So that means they're going to be selling the yuan, buying against every currency, but the dollar's going to be the main one. I think from a technical perspective, I've been watching this one for a while. It's really been doing nothing for the last few weeks, but moves down to sort of that 680, 679 area, potentially looking good, at least on a technical basis. And if there is this increased rhetoric coming in, it's going to step into the market at some point, and the market's going to take notice. So I think being on the long side in this one potentially is going to pay dividends. You can take it, as I say, a technical trade into that 679, 680, start to build some longs up there. That's what I'm going to be looking to do. And if the headlines drop the right way, then this could rally all the way back up to those 730s highs if the news gets really bad. So yeah, a long bias for this one. Like you say, sometimes it's worth just getting into positions, and doesn't have to be big. You can just have a little piece to stick in the bottom drawer. And if you do get something coming out of it, then you're on the right side and you're going to make some pips out of it.
Yeah, absolutely that. And of course, if it is a small position, just consider it a hedge. If something kicks off, we're going to see a move in a big way. And you would hope to be on the right side of that move. The apprehension I always have with the CNY or the CNH, whatever you want to trade, is the government, is the PBOC. They really can just step in at any moment with either jawboning or with a monetary intervention, and everything changes very, very quickly indeed. So I think that's the other reason why, when you're trading pairs like this, position sizing, probably keep it a little bit smaller than normal, keep your stops relatively tight as well, and just be on alert for those potential comments that we could get from policymakers, which do happen all too often, because there is a bit of a tendency to give a running commentary on things, isn't there?
Yeah, that's a very important point. If you do get big moves in the yuan, you then have to listen out to the officials, be it the PBOC, be it one of the other, many arms and acronyms they've got over there. Because if the yuan moves too far, they will come out. They'll either give it the green light and say, yeah, we're not worried about it, and then it continues, or they'll say, to coin a phrase that they've used previously, this move isn't going to be one way. And that's it, and it's pretty good for trading. And this is why I like trading this pair, because they do give those clear signals. So if you are on a big move, you're making money, it's going the way you want it to, you get a comment like that, it gives you a chance to get out. If the comment is against you, you call it into the trade, and then you let them do what they want to do. But they will guide it as they will. But they let it run a little bit before they start speaking about it.
Absolutely. It just makes me nervous. Any country or currency that holds a daily press conference on foreign affairs and markets is a little bit, I don't want to touch that with a barge pole. But anyway, something else I don't usually touch is gold. And the reason why is because I always kind of put it in the too hard basket. There's so many things that can drive gold, and often it doesn't seem to have any real logic as to what's driving it at any one time. It could be what's going on in treasuries, it could be inflation expectations, it could be haven demand, risk appetite, or even the direction of the dollar. But it does seem at the moment that gold is being driven driven primarily by the direction of the greenback. I think I tweeted out a chart last week. I'm sure you can go and find it if you want to. If you plot gold against real yields, against nominal yields, against equities, and against the dollar, the correlation with the greenback is by far the tightest out of all of those. And obviously, as we've said, we're expecting the dollar to continue rolling over. The short side, playing the dollar from the short side, does seem to be the way to do things at the moment. And that should be good news for gold. Although I would caution, of course, we had that big move higher in treasury yields after the payrolls print on Friday. I think the 2-year was up by 20 basis points or so. So, of course, that is likely to pose a little bit of a headwind as gold reopens for the new trading week. In any case, we had a huge rally in gold last week, and in precious metals more broadly, actually silver and platinum tagging along for the ride as well. This was after the JOLTS number on Tuesday, that job openings print, which came in below 10 million, below expectations, forced gold through $2,000 an ounce, and importantly closed above that level as well, which does give the bulls an element of control over the market. Personally, I think the all-time high remains in sight. Of course, if we do see a more hawkish pivot from the Fed, if we do see the market start to reprice in a more hawkish direction, that is likely to pose a headwind. But all the time the bears are in control of the dollar, I would like to be, and of course gold remains above this kind of 1960, 1950 level, and ideally above 2000, then I do think we are looking for this to move to the upside. And of course, if we get a hotter than expected CPI number this week, that would help things out there as well.
Yeah, I think the risk side of the trade is perhaps being seen in gold as well. You keep an eye on things like commodities, throughout the day, throughout the week, just to see. You get a little bit of a clue as to what's happening in FX and other assets. Is it all a risk move? And if you look at gold and compare that to oil was, really slumping a few days ago last week before we got that OPEC news that bumped it up. But then gold was going the other way. And so I think there's a lot in the mix with gold at the moment. I think it's important. Above 2K, that's really your big line. If we're holding above 2K, then the upside is definitely the direction we're looking at. So trading wise, you've got your 1960 level. If that's your pain level, you're wrong below that if you're looking for longs. But yeah, I think there's a lot in the mix for gold, and particularly on the risk side, as mentioned, talking about China. So that will favour the upside as well. And if something like that does kick off, the all-time highs are going to be, quickly forgotten. We're probably going up to something like 2,500 or thereabouts. So, yeah, a lot to keep an eye on there in this one, and I favour longs myself.
Yes, absolutely. The other thing just to mention in terms of gold, if you price it in sterling, we're at an all-time high already. Euro too, Aussie, we're close to it. Yen, if you really wanted to trade gold in yen, I think we're at all-time high there as well. So definitely strengthening across the board. And as you say, that feeds into the idea that there's also other factors at play. You mentioned oil. What about that? What's going on there? We obviously had that big gap higher.
Yeah, and we've gone from pillar to post really, because we looked at this a while back, a couple of weeks ago, and we were nudging around those lows, the 72 area. We got the breakdown, and it went for $8. So when this one breaks the range, it can go a bit, and that's what you want to look for with trading. So there's always two ways to trade it. So on the upside here, we are getting up into 82 level, big level 82.50, as you can see on the chart there. It's marked the top of this recent range. So I'm looking at this one potentially for a short onto that level, because, as we like to say, a level's a level until it's not. But I'll also be looking for maybe switching that pretty quickly into a long if it breaks. And you can just see that small circle I've highlighted there. When we got the break of that 72.30 area, it came through initially, went down to the low 70s, then it bounced again, hit that break point, and that's a real key technical play there, because it went back up to the broken area, it confirmed it as resistance again, and then we got that move south down to the 64s. So the same thing I'm perhaps looking for up here. Yeah, we might hit that 82.50, hold it as resistance. Shorts then can make some decent money, but if we break and we come back and test that level again and it holds the break, that's when if you've missed the initial move, can get into a long. And again, maybe run it for $5, $6, $7 or wherever it wants to go. So yeah, I'm looking at that level, very important level. These are the sorts of levels I love to trade because they're big and juicy.
Indeed. I think it's really interesting, actually, that obviously we had that big gap higher, as you would expect, on the OPEC news. But the market just hasn't really been able to extend those gains. And as you said, we've been capped here at this kind of 82, 82.50 level. And I think, well, firstly, that's obviously not what OPEC would have wanted to see. They would have, hoped that this would cause, I think, a more sustained rally in prices. But I think from the fundamental side of things, this is the market saying, well, you can cut supply as much as you like, but if the demand's not there and if the economy is slowing and the demand side is going to fall off, then that is not really going well, that's certainly not bullish on the price. You can take supply out of the market, but actually you're just balancing things up rather than causing any sort of tightness. And I think the other thing is, an old saying that I know you've heard and used before in your time, gaps tend to be filled. And that's very, very true when it comes to crude, probably more than most other assets. And the fact that we haven't been able to break through this level tells me at least that, we are looking, or the market is looking, to fill that gap that we saw last Sunday. Because if we don't see the demand side recover, then there's really no reason for sustained higher prices in the medium term, I don't think.
Yeah, well, I put gaps in the same witchcraft basket as Head and Shoulders. It's not something I look at. I don't trade them because, gaps can last forever. So, yeah, not one in my playbook, but you're the new technical genius, so I'll let you have that one.
I was going to say, that's not in the same playbook as Elliott Waves as well, is it? They are banned from this show. Cool. With that said, done. Let's get some actionable ideas and I'll play of the day. So I want to look at FX crosses for, I think, the second week running now, actually. I looked at Euro not last week. Aussie Kiwi is what I want to look at this week. And as Ryan alluded to earlier, we've got quite a clear divergence coming out down under when you look in terms of monetary policy. The RBNZ last week, it's gone a little bit under the radar, but raising rates by 50 basis points. Markets had priced 25, and I think economists were overwhelmingly expecting a 25 basis point move as well. But more importantly than that, they were actually pretty hawkish. When you read the statement, they were very much guiding towards further policy tightening in the months to come, probably in May, and then perhaps even at the meeting after that as well. And that's in contrast to what the RBA was saying, which is, they're on pause. And I think pause really means the hiking cycle has come to an end when it comes to Australia. The RBA have got to give themselves a bit of flexibility, a little bit of optionality, just to avoid too significant a loosening of financial conditions. But I think we all know that the RBA have brought that tightening cycle to an end with rates at 3.6%, and the RBNZ are likely to continue raising for some time to come. If you look at rates, if you look at what's going on in government bonds down there, you're seeing two-year spreads widen quite significantly in favour of the Kiwi dollar as a result of that. And, of course, from a technical level, we've broken below the bottom of this range, which comes in around 106.70, 107, that we've traded for quite some time now, the red line on that chart. So I think a lot of things here are aligning for a move lower. Initially, I would look for a move to around the congestion that we saw last December, around 105.50. I guess the risk with this is if the RBNZ suddenly get cold feet and back away from this hawkish stance, or even the RBA, we've all misinterpreted it, and Philip Lowe raises rates again. But I think the politics of that will mean that he doesn't go down that path. I think if we get a move back north of sort of 107.25, 107.50, then I'd look to get out of things. But I think Aussie Kiwi lower is where I like things at the moment. Although I would just caution, this does tend to move very slowly and steadily. So I don't think we're going to get an impulsive move down there. I think it's more of a bearish trend that is starting to establish itself than anything else. Ryan, what are you looking at this week? Dollar yen?
Yeah, dollar yen is the one I'm going to be looking at. I've wanted to play this from the short side for a long while. I've been in and out. I've missed trades. I missed one last week, funny enough, just before we were doing the show last week. I was looking at this one after all the news and everything, and it was creeping up to that 134, and I thought, do I have a little smack on it and just stick some on, but no, I hit the beach instead. Didn't want to spend my holiday looking at my phone every 5 minutes, but I'm favouring this one from the short side. I did get into a little bit last night around 132, nothing big. I'm looking to perhaps build into a short position up into the 134s, 133s, maybe even high as the 135s, just because I feel that the evidence is mounting up as to why this might be a decent short. We know what the Fed are doing, and the market not giving up the bone about turning to rate cuts. We've got obviously the new Bank of Japan governor coming in. That the changeover is happening now. Probably by the time we've done this, USDJPY has made his first big appearance, so we'll know how he's setting his stall out now. I'm not expecting the Bank of Japan to do a massive switch to the hawkish side, but any small indications that they're going to move away from the current easy policy is going to be big for the yen. And I don't think the jobs market in the US can hold up forever. So if it becomes a point where that's the last domino still to fall, the market still not, it's probably going to ignore good jobs number if the rest of the data is not looking good. So I just see more and more evidence that I should be on the short side of this one. So I've started already, and I'll be looking to get in the higher we go up.
Good stuff. Well, that brings us to the end of another show. Thank you very much, as always, Ryan Littlestone from Forex Flow Live and Forex Analytics. Thank you, as always, for joining me from sunny Spain. I wish you a safe trip back when you make your way over this week. And thank you, as always, to Kyriakos, our producer, for bringing this together so brilliantly. All three of us will be back this time next week. In the meantime, drop a like on the video, leave a comment, let us know your thoughts, let us know how you're trading the markets, and we will speak to you again very soon. Thanks, as always, for watching, and goodbye for now.